Welcome to another episode of Sit Down with Saxon. Last time I spoke about how a digital platform can underwrite a £10 million asset and how to do it using algorithmic underwriting, assistance with AI and so on. And this episode I'm going to talk about the high net worth space that we operate in as Saxon, what's ahead and probably what they need to do, the insurers and this space need to do in order to stay ahead of the game. Now, Lloyd's of London have an incentive, which is the Blueprint 2, to bring that marketplace together. And it's hopefully going to revolutionize the way that brokers who are Lloyd's brokers trade with Lloyd's. But it's a huge job and project, and it will take a very long time, and unlikely is it going to be ready this year. But let's see what happens. In the meantime, non-Lloyd's brokers have to trade with company markets or MGAs in the high net worth space. But there's been some difficult times in the high net worth space, and I'll get into that now. But let's just talk about Scott McGee at Insurance Post, with a little bit of my input, wrote an article last year about why MGAs are dropping like flies. MGAs, what is going on? Now, the MGA market is a really interesting one. They do come quite quickly, but also they disappear quite quickly sometimes. Not all of them, some have good track records, but the average age of an MGA is 3 years old before something tragic happens. And there's reasons for that, and the solid company insurance market out there will be the ones that champion themselves and say, we're not an MGA, we are an insurer, we are the strongest part of the market, and why would you use an MGA because of all those risks involved and so on. And to some degree you have to listen to them and say, yeah, true, like you're not going anywhere, let's hope. But some of these MGAs have come and gone quickly for a fairly good reason. Now, on the last episode, I even said that MGAs often try and build a huge book of business as quick as possible using extremely low and competitive rates. But there's a problem with low and competitive rates: losses. Losses can blow up a book or an MGA in no time and effectively kill a business. So it's a bit risky. Horizon Underwriting, Aurum, Grosvenor Westropp, Helvetia stopped writing high net worth, Homer Legacy, they're just a few victims. Some of them lasted longer than others. Then you've got Azure, they managed to sell before their capacity was withdrawn, so I hear, that's not gospel truth. Scott said that in his article as well. And it just begs the question, is the MGA model sustainable? Thin margins anyway, rising claim costs with inflation and so on, buyers wishing to spend less on their insurance, so customers want to trim down their insurance, meaning they might insure less of their items or fewer of their items. MGAs have to cover their commission, they have to also cover the broker's commission, and that doesn't leave a lot left in the pot for an insurer. Add in then, like I said a minute ago, one major loss of like £1 million, and a two-year-old MGA is looking like it may not get capacity the next year, because that could blow up the whole book, and their loss ratios are into the hundreds. So what happens next? What happens in the market? Obviously people want to be dynamic and want to start to put out some technology and work in this high net worth space still. But does that mean that the MGAs are going to stop coming into the market? It's definitely going to slow down because there aren't so many insurers that want to give them capacity. This means the whole setup has to change. Now, the insurance market is one big giant. It does not like change. But if Lloyd's of London have this project of Blueprint 2 and they are changing, then the company composite market must change as well. There are some people that I've been following and engaging with on LinkedIn, and they're saying to themselves they're really worried about the high net worth space, fewer markets available to send risks to get quotes, from quotes such as high properties in high flood areas or high subsidence areas, straight declines, not even getting entertained at all by an insurer or an MGA due to their very tight, narrow appetite, which we also spoke about on the last episode, but that's fair enough. However, should these insurance companies not broaden their appetite slightly and work a way of underwriting risks in a little bit of a different fashion? Now, first off, digitalizing that space can really help underwrite risks in a different way. Plus the use of AI, plus APIs that go off to certain third parties that bring back data to assist these underwriters, or even a broker with an underwriting platform that's offering quote and bind services. They can use these systems to enhance the customer journey and make sure that most customers are assisted within appetite, but underwritten in a way that really works for both parties. That means if it's in a high subsidence area or high flood area, let's use that example, and they might have a basement or so on, then you need sump pumps. You need servicing of sump pumps. You need to perhaps apply a higher deductible or excess for flood. And customers will be okay with those things. Customers are not afraid of having a higher deductible and so on. Talking of the high value space, even Helvetia have stopped trading recently because they were also doing the wrong thing. They were pumping out rates too low, and a few losses in that space, which is the yacht market, and it destroys a business. So there's a theme running through the insurance market, and that is that yes, rates have gone up and it's hardened the market. Appetite has shrunk massively. The market has shrunk massively, especially in places like the high net worth space. So we need to pivot, and we need to leverage digitalizing this area and using platforms to help us all underwrite risks in a better way. But what if we traded in a more modern way? What if headcount could be less? What if certain products were only allowed to certain brokers? Key accounts, for example. What if they used a more sophisticated system than other brokers? Are submissions coming in from various different brokers in various different formats not declaring certain information because that one broker has not done their job correctly? So then you don't necessarily give these new products or a product to only the biggest accounts. You give them to the brokers that have already proven themselves that they are really good at what they do. They only look for good quality risks, and they have a great submission process, and they always find all the details. Any insurer you speak to will say there are culprits out there who do not give the right information to the insurers, and therefore they have to either go hunting for it, or they have to just straight decline because they haven't got enough information. So this means there is just a way better way of doing things nowadays. Insurers spend a lot of money on distributing via many brokers. Leveraging technology, you could narrow the number of brokers down to the ones that you want to work with, the ones that are forward thinking and dynamic and can implement things on their website and so on. The manual way requires a lot of humans, which means they are humans in the loop. Now, we've spoken about human in the loop versus human on the loop. Human in the loop is the old-fashioned way, we've done it for hundreds of years. Human on the loop is the modern way where a human is watching and overseeing from above, and they dip into a circle of transaction circle, they do what they need to do, and they pop back out, and that can take seconds or minutes. So all of this hardship in the high net worth space can actually be avoided, and it can certainly be a goal that most brokers and insurers, or even MGAs and brokers with binding authorities, can work towards. My question is, why are we not there yet? Why are we not trading 100% digitally in the high net worth space? Why are risks appearing so complicated or risks that are complicated appearing in systems, and not enough work is done by the system to help establish if that property or asset is worth insuring, and if it is, how to underwrite your way round it so that the customer gets something and you win the business as an insurer. Let's look into the reasons why insurers that give capacity as a binding authority to brokers for a quote and bind platform can work in a more digital way, and why they should, so that the customers with these properties and so on are much better looked after by us. First off, cost reduction. The manual process is very expensive. There's too many humans around. We need to trim that down. You can use technology to leverage everything that a human can do now, with a human dropping in the loop and popping back out when they need to. This lowers the COR, improves profitability, and reduces the reliance on costly manual processes. Efficiency. I love this word. I use this word all the time in my business. We run in the most efficient way possible, and so should you. And we are still a manual broker, but we use technology to our advantage hugely already. Plus, we've got this new system which will make us even more efficient with the binding authority. So, operational efficiency for us and insurers. Digital platforms enable faster quoting and underwriting decisions. SLAs are so bad in the high net worth space. Rewind 10 years, you could pick up the phone, get a quote within an hour, and someone's done it. Nowadays, it doesn't work like that. It's such a disappointment. So if you can get a fast quote, i.e. if you're a customer or a broker, and you can get a fast quote in seconds and minutes while the intent is so high, you have a much better chance of converting that business and building a profitable book. Not only that, but it's efficient. That's the key word. It's scalable. Digital systems scale operations without proportional headcount growth. We touched on that on the last one. You don't even need more staff. This year, we're going to be squeezed even more from the budget. So do you need those staff that you're paying higher national insurance on this year, or do you need to leverage technology better? The answer is the latter. This enables insurers to grow their business without additional overhead or administrative burden, like we just said. Right, data utilization. We touched on that last time as well. If you're getting data into your funnel, which is your system, you can leverage this data as well, and you can use it. Therefore, you can have advanced analytics to enable better risk assessment and pricing. The more data you have, the more that you can use it to make better decisions. This reduces things like loss ratios, enhances underwriting accuracy, and it improves the portfolio performance. This is music to everyone's ears, right? Market responsiveness. Real-time data allows adaptation to changing market conditions. Yes, the APIs that your system might be calling on could be saying to yourself, well, that's a bit higher risk this time, that's where the thefts are, that's where the floods are, this is high subsidence area, and it's real time. We've had some mad downfalls of rain this year, and some places might become a floodplain. You need to use the data and the technology that you can get from those third parties, not even the technology, the data from those third parties, to improve market conditions. This ensures insurers stay ahead of the market changes and adjust quickly with emerging risks. So things that are changing, you can adapt to instantly. Don't wait. Not waiting for a human to import a report that came in from something over there and all of a sudden now you might be using it. Lower distribution costs. Yes, you could lower the headcount if you wanted to. Even if you didn't lower the headcount and you distributed your products out through multiple brokers or to the market, the direct market, then this is a lower distribution cost because it doesn't need a human to do it. It's system generated. Once you've got something on your website, distribution is almost down to your marketing, but it's much cheaper. This maximizes return on investment on distribution channels and reduces overall distribution costs. Future-proofing, the final point. Digital adoption ensures long-term competitiveness and relevance. Who doesn't want to be relevant and who doesn't want to be competitive? You do. This means it protects you against market disruption, those MGAs coming in and out, and positions you for sustained success. Happy days. So, back to what we're saying. This highlights the core benefits and direct impact that insurers or insurers giving binding authorities to, probably not MGAs, but let's just say brokers. It emphasizes efficiency, the cost savings, scalability, alignment with industry trends, and therefore your partners will want to work with you more because you will be one step ahead of them. Now, another comment I saw the other day was, please, can we not have to use so many broker portals? Every insurer out there now has a portal that they want you as the broker to put the information into so they don't have to do anything. Well, I get that, right? I totally get that. But there is a problem. A lot of brokers have a fairly substantial market that they might go to in the private or the commercial space, and therefore they need to input data over and over and over again. That's one thing that is in Lloyd's blueprint actually, is that they want to stop rekeying, stop the duplication of having to show risks to multiple insurers. But that's a marketplace. We don't all have access to that, but we can take things away from what they're planning. So there we go. That puts a spin on the digital movement that the high net worth space needs to adapt to stay ahead of the curve, so that brokers like us, insurers like you guys if you're watching this, and MGAs in the middle there can work out a way of just using technology to leverage our position and effectively grow a really, really good business. I hope you liked this little episode. I'm going to do loads more like this, so just stay tuned. You can subscribe if you like.